Hi guys, welcome to my channel. My name is Yubrats. Today in this video I'm going to discuss why do people lose money in trading. In 12 years of my trading history, I have found some major reasons behind losing money in trading. In this video I'm going to summarize those reasons under 10 key points. So let's go. Let's start. Okay, so alright, so if you are losing money, you might be trying to find out to recover the loss, how to recover the loss. If you focus on this video and then try to improve your trading based on this video, definitely you can recover your loss. Okay, so the major reason of losing money in trading. So what are those major reasons? Let's go one by one. The first reason is emotion. Second is overconfidence. Third one is big trade size, being greedy. Fourth one is no stop loss. Fifth one is revenge mentality. Sixth one is trading without strategy. Seventh one is frequent trade execution. Eighth one is database trading. Ninth one is lack of trading discipline, and the final one is lack of patience. Let's go for first one. First one is emotion. Emotion is the psychological state of mind that is shaped by thought and feeling. As emotion works, the door of logic and reasoning will be closed. It makes the traders blind in the name of expectation. The losing trade continues and it moves. For example, let's see in this figure, this chart. Okay, so here, if someone is a bullish, he will be keep on bullish, and if he loses some money here somewhere else, and he will be more emotional, he will aid more money, keep on aiding, he will keep on going aiding and aiding. He becomes emotional, he wants to recover money based on his emotion. He said that he will beat the market, and then he keeps on investing. Here you can see that market does not go up, it keep on going down. So if we become emotional, then we lose the money. If you are emotional, if you use emotion in trading, please avoid this, because it does not help us. It makes us loser, and finally it wipes out our trading account. Now let's go for second one. It is overconfidence. If you are overconfident, then you lose money, because there is no certainty in the market. Overconfident is a well-established bias that exceeds the reality. It makes traders assuming market will be 100% on their side, but there is no certainty and market can go either side. It makes traders to act blindly without logic and reasoning. It does not follow any strategy or money management strategy, which makes great loss. So this is also another major reason people lose money. So if you want to recover your loss, avoid this overconfident trade based on strategy. So how overconfident makes us lose? Let's see this example here. Okay. Overconfident incurs big loss. Okay, that's the thing. Now let's go next one. That is third. That's the big trade size. The profit or loss amount depends upon trade size. The bigger trade size make a higher loss of the money. The market can be unpredictably volatile and incur great loss if the trade size is too big, even the market trend is right. If the trade size is small or manageable, your account will not be blown up with the adverse movement of the market. Let's see this chart. Here, you can see here this is because of some data from this level 13,000. This is a Nasdaq 100 futures trade, Nasdaq 100 futures chart, and in this chart here, this level, this is 13,149, and suddenly it goes down about 200 points. Then after it recovers and it went up. But if your trade size is big, even you were in the right position, you lose the money. And when you lose the money, when you are out of the trade, then it goes up. But if you had a small trade size, you wouldn't be in the 200 point down. But if big size, then it incurs a big loss. You exit from the trade, and then after that it rise. You can see, even if you are right direction, you lose the money. So always be careful that your trade size that must be manageable. Now let's go to another one. That is a fourth, no stop loss. If you do not put a stop loss, then you'll have a big loss. If the market or trend changes, if it goes in your own side, that's fine. But if it goes in adverse side, you will have a big loss if you do not have a stop loss. Before placing any order, you need to find support and resistance label, which helps you to put stop loss in the right place. If you do not keep a stop loss in the proper place, you lose the money even your direction was correct. So here you can see, if you trade here this label without a stop loss, no matter how much money you have, it keeps on going, and you'll have very big loss. So you think that the market will come down, keep on waiting, it never comes down. It keep on going. That's the reason you need a stop loss to manage your trade, no matter whether it is a big trade size or a small trade size. Always keep a stop loss in the right place. Next one, revenge mentality. Most of the traders, they have revenge mentality. It is the human nature that blocks our judgment and evaluation power and encourages us to challenge the market. If the market moves opposite direction of our trade, we think that market will shortly reach to the previous point, and we aid further trades to increase the profit and revenge the market, but there is no guarantee of recovery. It might go further more, and we we lose huge amount. For example, you can check in the chart. Yes, see this? Here, if you are not flexible, see here, from this label, if you are not flexible, or if you can't change the trend and then keep on waiting, it will recover. But here you can see that people, they become confident. Okay, for a long time it's a daily candle of Nasdaq 100, so for so many days it has been increasing. The market will definitely increase. They become overconfident, other than they enter. If they enter here, you can see here how big, how it's falling. So you need to trade based on the trend, market trend. Never challenge the market. Never challenge the market. Okay. So if you try to challenge, if somebody try to challenge somewhere here, if they think that, oh, market is here, this market is going down, and then now it might be buying opportunity, and if they buy, if they challenge the market, so see, it keeps on going down. So never challenge the market, just follow the market. Now let's go another one. Trading without a strategy. Trading without a strategy is only gamble, but also not only gamble, but also more than gamble. It's worse than gamble. In every trade, you must determine suitable trade size based on your equity, put stop loss in right place, have exit point, and determine waiting time as well. If we enter the market without determining those aspects, sooner or later we'll lose the money, even though we make some money from a couple of lucky trades. For example, you can say in this chart, see, you can see here, do not gamble. If you don't have a strategy, so look here, if without a strategy, yeah, buy here. Okay, so here market is falling down, people, they sell from here, it's going up, and when it goes up, some people they sell, people buy, because they see this green candle, it's going down. Okay, so here some people they try to buy, but market's going down. Here they try to sell, market goes. Okay, so actually this is the resistance level. Okay, this level, they need to understand that from this level it can fall down, so wait for this level and then sell it. And here when it comes support level, then at that time try to buy it, and when it breaks support level, again try to sell it. Let's go to another one. That is the seventh one, frequent trade execution. Frequent trade execution is the sign of emotional trading. This type of trading depends upon luck, and it is also fully gambling, but not a trade. Here you do not know your chance of winning percentage, thereby you might lose all trades. You should have a market entry strategy that secures your trade. Although there is no 100% success, the market entry strategy helps you to succeed at least 50 to 80% trades, which makes you profitable for a long run. For example, here, if somebody keeps on buying and selling, they will not have a profit. They have to pay for the platform, and then they might lose several trades, and then they might win only few trades, and ultimately they will be loser. That's the reason frequent trade also, it's a bad habit, so you need to avoid that. Number 8, data-based trading. Every day some data are released which will have a significant impact on the market. It makes the market volatile. The data impact will be for the short term. Its market is controlled by the giant investors, but the general traders enter market as soon as the data release. The market also entertains the data to some extent, and the trader will have high ambition, but suddenly it is controlled by giant investor and it follows the trend and will lose the money. For example, here you can see this candle, this Nasdaq 100 future candle. It's the 4th of May, and when the interest rate was increased from 0.5% to 1%, that time the market suddenly increased. Here most of the people here, they buy and then they believe that okay, next day it will increase, but from that point it keep on decreasing. So only based on data, do not trust those data impact or those data's reaction. Just follow the market trend, because this data's impact that will be short term, that will not be long term. Long term, that will be the trend. Now let's go to another point, that is lack of a trading discipline. If we follow system or stick on the market discipline, we never lose our money. If the market says exit the market, we should have a courage to exit the market even in loss. As for example, if the market breaks support, there will be high chance of market to enter into the bearish market. Sometimes we become greedy and remove a stop loss and expect market to recover, but it incurs a huge loss. For example, in this chart here, see here in this chart, some people, they can't be greedy, and then even if it is trading below the average, moving average, they keep on waiting, and then finally it keeps on going down. Some people, they can't be patient, they don't have a patience, and then here from here couple of hours, this is an hourly candle, they become impatient and then they exit the market. This level, they can't wait. If they can't wait, they can't get money, they can't earn money. So we must have a discipline. And here another point is here the resistance level is, this level is the resistance level. If we don't follow the discipline, we are not in discipline, and we put our stop loss very tight somewhere else here, so we exit from the market and the market goes down. Just find out the proper resistance level, and some point above the resistance level put your stop loss. It's the discipline, and then do not touch that. If you exit, okay. If market exit, fine. Otherwise, just wait, be patient. The final one is lack of patience. In the market, we should have patience to wait, as the market can move at any time. We want a quick money and do not want to wait even for few days. In our job, we wait 1 month to get salary, but in trading, we want it immediately. So we trade a big size. We try to trade every moment, which makes the trade a mess. If we can't wait, we can't win, and ultimately we'll be loser. For example, in this chart here, some people, they can't wait. Look here, this is the hourly candle, Nasdaq Future 100. It's slowly, it's keep on increasing and again going a bit down, going up and again down. It's a keep on going. Slowly it's a going down, but some people, they don't have the patience, and then when they have some profit somewhere else here, and they exit and they miss the opportunity. I hope this video is helpful for you to trade. So if you like this video, just like it, just comment it, and then subscribe the video. I will keep on making different videos. And what type of video do you want? Just you can comment under this video, and then I will try to make suitable or the video that you wish. Thank you.